I want to tell you about a spectacular dining experience. It's Ports a Call Waterfront Dining, award-winning service and cuisine with a view of the dynamic L.A. harbor from every seat. Enjoy daily sunset specials, as well as the South Bay's best champagne brunch. The outdoor harborside patio is a perfect setting for happy hour every weekday from 3 to 8. Ports a Call Waterfront Dining. For reservations and directions, visit portsacalldining.com or call 310-833-3553. Thanks for tuning in. It's Phil Hulett and Friends at .com. And you're at our website. We're on Twitter at FAF Show, FAF like Phil Hulett and Friends. And we're on Facebook.com/Phil Hulett and Friends. We want to talk a little bit about mortgages, about loans, about refis. If you're a homeowner or thinking about buying a house, it's an important thing to consider because things are always changing, including the rules and the interest rates. And joining us live in the studio is a guy who knows a thing or two about said subject is Jeff Lazerson. He's from mortgagegrader.com. And if you forget what that is, we'll repeat it a couple times. We also have it linked on our links page at philhulettandfriends.com. Welcome to the studio, Jeff.
Thanks for having me.
Yeah, always great to see you. First, tell us what we find when we visit mortgagegrader.com. It's a pretty much a full-service website, isn't it?
Yeah, I'm a mortgage broker in California, and I had developed a pricing engine that a lot of companies around the country use for the consumer so that you get the best price no matter where you live or what you look like. It doesn't matter. It drives the mathematically best deal to the consumer, not to the lender.
All right, very good. Now, it seems like the Fed chair wants to raise interest rates, but the board wants to wait a little longer. Do you get a sense how much longer, and does the current rate of inflation really justify hiking the rates?
Well, we're going to see rates go up about a quarter point this year on the short term from the Fed. It's probably going to happen sometime. My guess is third or fourth quarter of the year. And the reality is, though, that the market is still pretty flat. There's not a lot of inflation out there. You talk to business people out there, some are doing great, others are still struggling. There's a lot of other expenses people have, utilities, taxes, healthcare, that are bogging things down. So even though the economy is certainly a lot better than it was 5, 7, 8 years ago, it's still not fantastic. Mm-hmm. And they're going to do a little bit of a raise, but not much.
All right, let's talk about today's rates. How about a 30-year fixed?
30-year fixed today is at 3 5/8%. That's $417,000 or less. Mm-hmm. And agency high balance, that's $417 and $1 to 625.5. It's at 3 3/4. So rates are just smoking hot right now.
Yeah. So you can get $625,000 in real money to buy a house and pay maybe $3,000 a month.
Yep. Yeah, that's it. And it's, I mean, if you think about how cheap money is, and then after taxes, the money's almost free. I mean, you pay 1.5–2% after the tax deductibility of it. It is the greatest deal going, and I would tell you that people, if they're thinking about investing anywhere in the U.S., real estate is a good thing because they're not building enough, and the population keeps growing.
Yeah. Now the trick is qualifying. Do you have to walk in the door with an 825 and have worked at the same job for 25 years and have a couple $100,000 in your checking account to make this happen?
No. There's programs out there with 3% down, 3.5% down. There's a 0 down if you're a veteran or in service military. That's a big misnomer. The thing is that you have to qualify income-wise. You have to show some stability in your life, job, credit, pay your bills. But we get a lot of people out there with really rough credit that qualify all the time. And the problem is you get all these scare stories about what went on 5 or 7 years ago right after the mortgage meltdown. It's a very different world. Is it tough to qualify? I don't know that it's tough. We put you through the rigor, though. The files are this thick instead of really thin the way it used to be. But most of the people get through it. There's only a few critical things that stop you. A recent foreclosure, bankruptcy, short sale. Those are the only hard stops. Other than that, there's workarounds, co-signers, gift funds, there's a lot of availability out there.
What about people that maybe they've had a couple of late pays on the credit card or something like that, or maybe they lost a job, and but they show the tenacity to stay above water?
So credit card lates aren't that big of a deal. Mortgage lates are a very big deal. If you've lost a job and you have a new job, not much of a problem, depending on how long you've been out of work and depending if you're in the same field or not. But each situation's different, and what you should do is go to your local loan officer and then have them run you through this underwriting engine. There's one from Fannie Mae called Desktop Underwriter. There's one from Freddie Mac called Loan Prospector. They do FHA, VA, and conventional loans on these two underwriting engines. Most all lenders do it for free just because they want your business. It doesn't take long. It takes them 15 minutes to take an application from you, run a credit report, and punch you into the underwriting engine. And if you get the green light and the approval, then you're good to go. You go out and buy your house.
Later in this program, we're going to talk with an expert on freelancing. And a lot of people don't have regular gigs these days, but they're making a good living freelancing. And does that make it more difficult to qualify?
No, because in fact, where we are here in Southern California, I do a lot of people from the entertainment industry, and that's very typical of what goes on. I have borrowers that have 5, 10, 20, 1099s and W-2s every year, and it's just a matter of showing the history of and the repetition that they have done this for a year or two or more. And that's all we need to do. It may be a little more paperwork and a lot more involved to document it, but it works just fine.
We're talking with Jeff Lazerson of MortgageGrader.com. And Chris, you have a question for him?
Yeah, I'm curious. Does a person's personality or tenacity factor in anymore with whether or not they're going to be approved for a loan, or is it just the mathematical nuts and bolts of like debt to income ratio?
Well, that's a great question. So it's debt to income ratio. That's one thing. It's your middle credit score is another thing. And then the third thing is what we call loan to value. Those are the three most critical points to it. Unfortunately, they've sort of boxed everyone into that. It's like either you fit into that box or not. Everybody has a story to tell. And and some people, they have a true, heart-wrenching situation that they should get some consideration on. And when this whole mortgage meltdown thing happened, a lot of that went away. Used to be years ago, I've been doing this 29 years, we would have loan committees and
Right.
we would sort of go through we called them cry letters. Literally, that's what we called them, cry letters. And does it make sense? And can you back it up? And can you give me a budget? And the underwriters and the lenders, they want to give people loans contrary to what a lot of people think. They want to give the loans. It's the regulators that scare them.
Well, let's talk about that because there are new rules that impact your reporting. No more can you come in and just say, okay, I have a little money in the bank and I've got no lates for at least a year, something like that, and I'm a good guy. Let's give me a loan. But you can't do that anymore, right?
No, something came into effect last year, January in 14, the qualified mortgage rule, that it really put a lot of rigor to this whole thing. If you were over a certain debt ratio, then basically if the lender gave you the loan and you failed later, you could actually claw back on the lender and claw back and say, you know what, you shouldn't have given me that loan, and so therefore I'm suing you. Honestly, that's that's the rules today.
So now the lender is going to be less likely to deal with somebody who's on the fringe.
Right, because the way the law is structured is if that lender is giving you something which you're sort of past that mathematical number, then the onus is on the lender to defend it. And so now a lot of the lenders say, well, you got to have 2 or 3 years of payments in the bank and make $250,000 if you want to go over this threshold.
Yeah. Wow. So as a broker, if I walk in the door, a freelancer, because maybe a year ago lost a job but have no choice but to freelance, but making things more or less work at the household, but maybe a handful of lates here and there, maybe a mortgage late, maybe one of them, and I've got a 575 because of that. I walk in the door with that. Do you say, well, sorry, can't help you? Do you say that, or is there an addendum to that and say, well, if you talk to this guy, there's like another program, perhaps you can work with that?
Well, if you said a 575 FICO score, is that what you're referring to?
Yeah, that's relatively low, is it not?
Yeah, it's very low. Now, FHA will actually go down to as low as like 510, but then there's other good compensating factors that you have to have. With 1 year self-employed with that credit score, that makes it tough. With 2 years of self-employed, you could probably get by even with that low credit
because
score.
you have a track record and the deposits to prove it.
That's exactly right.
Yeah.
And there's even programs out there now, 20% down. I just wrote in the column that I write, I just wrote about it this past weekend, 20% down, 1 day out of bankruptcy, foreclosure, short sale, 1 day out, and with a 580 FICO score, we get you a loan right now.
Wow. Is it a little like the old days? Like, well, wait a minute. You don't qualify for a 3.5% loan. You don't qualify for a 4.25%. But we can get you a 9% loan and make it like a 5-year adjustable, something like that. And in between now and the 5th year, if you can get your act together, we can refi that down to whatever the going rate is for a 30.
Well, it's better than that now. They're 30-year loans, not the 5-year ARM. There's no prepayment penalties on them. The rates aren't quite that high. There's other limitations about how much you can charge people. So this particular loan starts in the high 5s and it goes up to maybe the low 9s. Mm-hmm. So all those nasty things that they had on the old subprime loans are gone. The balloon payments, the prepayment penalties, the crazy stuff, that's gone. So you might deservedly have to pay a little higher rate because you haven't shown responsible credit history, but they're not as bad as all that. And because there's no prepayment penalty on it, in a year later, you get a little better score and show some good mortgage history, you can get out of that into a regular loan.
Jeff Lazerson is with mortgagegrader.com. We have some more questions for you, including how much should the broker make? How much should we pay in points? Is it negotiable? And just if you can walk us through what we need to have ready to go when we're serious about walking in for a home loan, a new loan, or perhaps for a refi, what we need to prepare ourselves for if that's ultimately what we want to get. And we're going to look for your expertise on this. Jeff, thank you very much so far for what you've told us. But more questions with Jeff coming up next right here on Phil Hulett and Friends. I want to tell you about a spectacular dining experience. It's Ports a Call Waterfront Dining, award-winning service and cuisine with a view of the dynamic L.A. harbor from every seat. Enjoy daily sunset specials, as well as the South Bay's best champagne brunch. The outdoor harborside patio is a perfect setting for happy hour every weekday from 3 to 8. Ports a Call Waterfront Dining. For reservations and directions, visit portsacalldining.com or call 310-833-3553. It's Phil Hulett and Friends. We're talking interest rates, refis, home loans, the whole mortgage deal with Jeff Lazerson from mortgagegrader.com. We were talking about the real estate, the interest rate earlier, and you said 3.5, something like that, or 3.45, I forgot.
3.625 for a 30-year.
Okay. Now, you can get a much lower rate if you want to squeeze down the amount of time it takes you to pay off your loan, like a 20 or a 15 or a 10,
yeah, that's right. Yeah, you can get a 15-year down at 2 7/8%. You can get a 10-year fully amortized down at 2.75%.
Wow. Yeah, but then still, you got to have the cash flow because it's going to be a much higher payment monthly.
Absolutely. Yeah, you have to qualify, and you should. You don't want to be doing something stupid where you can't, you want to pay off the loan and you can't afford it. You need to live too.
But is it smart to pay off your house? People talk about that all the time. Well, maybe you just go ahead and you can't take the money with you.
I am very conservative. I think everybody should pay off their house. I just think it's one less thing to have to worry about. Mm-hmm. A lot of people think they just don't agree with that mindset, but I just think
some people look at it as, well, my mortgage is the cost of doing business, and that's how much I'm going to pay every month for as long as I'm going to pay. And if I could get it lower or get more for less, and keep doing that as long as I can do it.
Yeah, but you think about not having a house payment at all.
Wow, what's that like?
Yeah, I know. And when you say that, what's your game plan on that? Do you just make the bucket where you put money in for your mortgage payment a larger percentage than the average person would? You lower your loan time, increase the amount that you pay down on it?
Well, there's a couple of ways to do it. The shorter term loans offer better interest rates, so that's one way to do it. Another way to do it is just throw extra principal toward your payment. So some people have variable income, they work off of commissions, things like that. Maybe they get it quarterly, and then they just throw a bunch at it every quarter. So but the whole point is You put your goal together on paper and you focus on it and you commit to it and you do it.
Yeah. Talking about that commission, we hear the ads on the radio all the time where the guy says, no points, no fees, we'll get you a loan, it's our money, yada, yada. And then you sit down and, okay, fine, what is this $900 right here or this $1,900? Well, that's our whatever. They have a name for it, and they don't use the word fee or points. And I don't know that that's necessarily a bait and switch, but just the same, how much of that is negotiable when you sit down, and what's fair when it comes to points?
Well, compensation, so the lenders don't have to this is another stupid thing about the system. If you're a direct lender, a bank or a non-bank mortgage company, you don't have to disclose any of your compensation. Mortgage brokers, every mortgage broker, we do have to disclose our compensation. So if the borrower is paying direct points out of pocket, it's called borrower pay. Then it's completely negotiable between the borrower and the loan person. And if it's what we call lender paid, where there's rebate pricing where you do these no point, no cost loans, then it's sort of preset like grocery store pricing. And the reason why they do that, the law says we have to do that, is because they don't want one person getting a better deal than another person, or they don't want a discriminatory situation coming up where different classes of people get charged more. So it's grocery store pricing, and it actually works really well. So what we do, 95% of our loans are done no cost. And the trick for the consumer that they have to appreciate is the way loans are rigged now from the government as of about 8 years ago. It almost never pays and makes sense to pay points and fees. You're almost always better off doing a no-cost loan, because if you take the difference, difference in the payment between paying the cost and doing a no-cost loan, you'll find it takes years to recoup that cost, because the government doesn't want you spending money on closing costs. They want you spending money on down payment or building up your equity in the event of a refinance.
Right. If you go from 2 points to 1 point to no points, the interest rate's going to tick up.
Exactly. That's exactly right.
Yeah.
And no cost is even better than no points, and there's even no cost and rebate to you.
Yeah. Now, you talk about making it fair for everybody from every walk of life, but I imagine the guy with an 810 FICO is going to have more negotiating ground to stand on than the guy with a 575.
Well, that would be a true statement, because most lenders don't do a 575.
Oh, really? Okay.
No.
Right.
There's very, very few that'll do something like that.
Drat.
But it's negotiating in broader terms of the loan, not so much the commission or the compensation. But one thing I will tell you, and I say this to anybody and everybody, is don't be so quick to grind the loan officer down to making nothing, because I'll tell you what, it's a really hard job. Mm-hmm. And if you're doing in a situation like that, guess where they're going to spend their time? They're going to spend their time on the deals that are paying them the fair rate.
Right.
So I will tell you, it takes 20 to 40 hours of loan processing time to put a loan together. It's a hard job.
If you're a direct lender and we do a 0.0 fee loan, are you making money elsewhere off the interest rate, right?
Yeah, absolutely. There's back-end money. They make most all their money on the execution or the sale of the loan to Fannie Mae or whoever they're selling it to.
Right. So you get the loan, and your first bill is from the people you did the business with, and then your second bill is from some other place.
Yeah, it could be. I mean, if they sell the servicing on it,
right?
They may retain the servicing and still sell the ownership of the loan to somebody else. It may be seamless where you don't even know that it was sold.
Mm-hmm. Yeah. Now, people get into a loan, and everybody, fine, it was good faith. Everybody believed that the family or whoever it was that applied was qualified. Mm-hmm. They get into trouble in 3 or 4 months down the road. And it matters who's servicing the loan from state to state, because there are programs, and I'm sure you're aware of them, and you can fill us in, because I'm only kind of sure that there are programs that people can apply for. And the loan and the house, if you're in danger of going sideways on your loan, gets protected, and perhaps there's some money coming from the state or from the feds to bail you out. Right.
So like in California, it takes, I think there's it's like a 6-month time period or something like that you, if you're in trouble, before the lender can take any of that foreclosure type action. New York, I've heard it takes years to foreclose on somebody in that state. But as far as helping people. And believe it or not, the lenders do want to help the borrower out. They didn't originally, but they got smacked down so many times for not helping them that I think they've sort of changed their thinking. So the best thing that somebody could do is if they have a problem, just lay it out there for the lender and ask them for help. Most of the time, they'll give you a loan modification where they'll modify your payments or throw principal on the back end of the loan or stretch out the loan. I mean, they've actually become very good at this because they don't really want your property back. They don't want the bad report card on them. So just come clean with them. Things happen, and maybe they'll help you.
A little bit of time left, just about 30 seconds. What do we need to bring emotionally and paperwork-wise when we're serious about getting a loan?
So the last 2 years' tax returns. So for example, right now is 2015. You want your 2013 and 14 tax returns. The last 2 months asset statements from each one of your accounts, a month of pay stubs, copy your driver's license, and whoever else is going to be on the loan with you. If it's a refinance, you want the property tax bill, fire insurance, and mortgage on the current loan. Those are the basics. And then emotionally, what you want to do really is what you should do is talk to 3 lenders. You should shop. You know, you're going to get a better deal if you shop
and bring
around.
your good disposition.
Yeah.
Like yours. Jeff Lazerson, mortgagegrader.com. Thanks for all the information and for visiting the studio.
Thanks for having me.
Hey, that's it for hour 1 of the show. More to come, including bizarre celebrity demands, a teacher who should be fired immediately, and what we learned when hackers got into Adult Friend Finder.